Hello, chart watchers, and welcome to this Tuesday, June 4th, 2019 Market Watchers Live Show with your hosts, Tom Boley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Taking a look at today's action, well, it is a very strong day on Wall Street today. The Dow Jones Industrial Average up 422 points, the S&P 500 up 45, the NASDAQ up 151, and the Russell 2000 up 26. 10-year Treasury yield bouncing up just about 6 basis points, 2.14%. We talked about yesterday getting below that 2.10% level was threatening a key support level going back a couple years. Today we are bouncing there. Volatility index, big move to the downside, down more than 8%, and now back down to 17.3. Technology, financials, consumer discretionary, three aggressive groups leading to the upside. Among the industry groups having strong days, you can see computer hardware bouncing off of a steady downtrend. Also, semiconductors moving higher after about a 5 or 6 week pullback. Banks, also one of the laggards during May, bouncing. Really, as you look across all these areas, the majority of the strength today, or the best strength, is among the groups that have been the weakest in May. Some of the leaders still having a little bit of trouble on a relative basis. The one exception, though, is the renewable energy space. This is a group that has been very strong, the strongest group in 2019, and we're trying to get another breakout here to a new high. So renewable energy having another strong day. Apple and Cisco, both helping the tech area move higher, both also in downtrends of late, but having very strong days today. Okay, Erin, I tell you, 24 hours makes a big difference in the market, doesn't it?
It sure does. We really had stretched out. I mean, we really had gotten very oversold. I think this is just a little bit of a relief rally. I'm not so certain we're going to see prices move that much higher after this move today.
Yeah, I'm a little nervous about it. It's a strong rally, and most areas are participating, and we do have strength in all of the aggressive groups. So it's exactly what you want to see on a rally. But it just seems to me like a lot of stuff was overdone to the downside. And a lot of this rally is just simply getting back what we lost on some of these areas of the market, like the semiconductors, which were pummeled during the month of May, all of a sudden getting a nice bounce. And I agree with you. There's still a lot of technical work to do here. There's no doubt about that. But we do have a special guest with us today. Rick Bensignor is with us again. Welcome back to Market Watchers Live, Rick.
Hi, guys. So nice to be back. It's probably been several months since we were last on together. So looking forward to talking with you and our listeners.
Yeah, well, we got you back during a pretty volatile time, as we've seen the market take a pretty good hit here over the last 4 or 5 weeks. But we are getting a nice rally today. Do you have any thoughts before we get into your presentation later? Any quick thoughts on what you're seeing today? I mean, is this something that might stick, or what do you think?
I think it might stick a little bit more than people expect. Yesterday, the S&P got down to 27.28. That was 1/3% from our target of 27.20. Timing models suggest now, too, for a trading bounce. So I'm not going to fight this bounce just yet.
All right. Sounds good. Well, I know you've got a great presentation for our listeners in just a bit. So if you'll hang around with us for about 15 minutes, we'll get right back to you.
Great.
Sounds good. All right, Erin, I think we ought to just go ahead and get this thing started. We got a lot to go over today.
Absolutely. It's a busy, busy day. All right. Upcoming schedule, though. However, Jesse Felder of the Felder Report is going to be in tomorrow. Actually, it looks like they'll be, yes, tomorrow. Jesse will be in tomorrow. Tom, you've got a workshop next week on Tuesday. Tim Ord of the Ord Oracle and the Top Advisors Corner. If you look at that in the articles page, he will be here on Wednesday of next week. And then mark your calendar, June 13th, we will have John Murphy on the show once again. It'll be great to have him back. Today's agenda, we're going to start off after the technical news and headlines. Rick will come back and give us his talk on institutional trading. I think you'll find that very interesting. 10 in 10, our first symbol is Veritone, VERI. Then we're going to finish the show off with sector rotation and relative strength. So let's go ahead and get it started. Tom, technical news and headlines.
All right, sounds good. Well, we really didn't have much in the way of economic reports. You can see on your screen there, just April factory orders coming out at 10 a.m. this morning. They did match expectations. So not a whole lot there to talk about. I think really it's when we take a look at the 10-year Treasury yield, it's more about the fact that we have just been straight down. Money's been pouring into Treasuries. We needed to simply have a move back up in yields, and I think that's what we're seeing today. So nice push back up off of this 2.8 area or 2.08 area, back up near 2.14. And as I've mentioned past, this 2.04% level was the low that we saw back in September of 2017. So here we are almost 20 months later and back down at the level again after really wasn't that long ago, 7-8 months ago, we were up above 3.20%. This is a big move down we've seen in the yields. I also wanted to look at this from a Treasury price perspective. So here's the TLT, which is the 20-year Treasury Bond ETF. And what you see here is a push to the upside, lots of money rotating into Treasuries, getting close to that high that we saw back in the middle of 2016. And so it just makes sense technically when you see an area like any kind of an area, but here with the Treasury bonds being so overbought after moving up like this, I think that it was just time to get a pullback here. I wanted to also take a look, and let me see if I can get this up here. Yeah, I've got it right here. So here is going back the last 4 or 5 years. I guess it's 4 years. And what I think is pretty encouraging is, and maybe I might even have one that goes back further. I'm going to see if I had that one. Yes, I do. This is even better. So when you look back, this is going back 15 years, and this is the TLT. And then down at the bottom here is the S&P 500. What you have to understand is rarely do both of these two go lower at the same time. And so usually what you see is money coming out of bonds and into equities, out of bonds, into equities, out of bonds, into equities. And a lot of times when you see this movement down in Treasury prices, that's when you get some of your biggest pushes to the upside in the equity market, because not only do you have new money coming in, but you also have rotating money, folks that are moving away from the Treasuries and looking for a little bit more in terms of aggressiveness. So this is really important as the TLT hits this overhead resistance. If it breaks out to the upside, that's where I think the equity market could have some problems. But if we do top at this June or actually July 2016 high on the TLT and start to move lower, I think that could actually be a big boost to equity prices and could help get this breakout that we're looking at. We did move just slightly above the 2018 high, pulled back, but I think we could get a really big push through there. One of the things that would certainly help would be the TLT backing off, yields going higher with that money rotating away from Treasuries. Okay, let's get into earnings. There were a few earnings out last night. A couple of smaller companies. We talked about these on the show yesterday. Coupa Software and Box. Coupa looked really good on the charts on a relative basis. Box did not. We're going to take a look at those two charts in just one moment. But here's a list of some other companies. After the bell tonight, we've got Salesforce.com, Guideware, Pivotal Software, Ambarella, some potentially big movers and volatile stocks. So something to keep in mind as we go forward here. But let's take a look at the charts first of Box and Coupa Software. Remember yesterday, we were talking about software moving higher, but Box being one of the underperformers. Don't get too excited. Well, look at what happened. The stock was almost at 18 at the close yesterday after breaking down. Opened today at 1541. Huge move down. Now, maybe this is an exhaustive gap. We'll have to kind of watch to see what develops after this. But at least for right now, this is not good action on Box. Nice recovery from the opening drop, but that gap down was not pretty. COUP, Coupa Software. Let's pull that one up. And this was a little different picture. We had a stock that had been rising, which was one of the better performers heading into their earnings report. They beat top and bottom line, failed to make the breakout with the report, though, and has pulled back. I think this is very typical of stocks. When they are expected to do well, they come out with a good report, and they can't make the breakout. I think that encourages selling in the short term. I suspect this stock will reverse back to the upside, probably sooner rather than later. A couple of areas to watch. I would say right around 99 to 100. We're almost there. If that level fails to hold, then I think you've got all the support down here just below 90. But I believe if the market holds and software starts to turn higher, I think you'll see some of this money rotate back in here. Tiffany's reported this morning. They did miss on their top line. They beat on their bottom line. They guided in line, got a little bit of a pop. But look at Tiffany's relative to the specialty retailers. Not so great. They get a move up with their earnings. I think it's more of a dead cat bounce than anything. Fail at the 20-day. I would not be interested in this stock at this point. DCI, this is Donaldson Company, another stock that was on a move lower on a relative basis, now threatening 52-week relative lows in a very difficult part of the market. The industrial machinery group had a very difficult month of May. And once again, after earnings, it gets up to about the 20-day and then turns back to the downside. Not looking very good here. Cracker Barrel, getting close to lunchtime. Probably shouldn't talk about Cracker Barrel. But anyway, this is a stock that did gap up a little bit. This has been a very strong industry group. Restaurants and bars looking to make an absolute breakout. This isn't a relative breakout. This is an absolute breakout. And given what the market just did in May, I think clearly, I don't need to show you the relative strength chart, but here it is. The restaurants and bars relative to the S&P 500 absolutely exploding. The problem is Cracker Barrel has not been one of the best stocks. It's actually been one of the worst stocks in the group. So even though it is getting a nice pop to the upside, it's got a lot of overhead technical work to do. I would look elsewhere in this space. Navistar International, NAV, checking this one out. The construction vehicles, you can see the group relative to the S&P, not great. The stock kind of just going along for the ride with the group, which hasn't been great. And you can kind of see it in the chart. I just don't see anything here that I would be overly interested in. Taking a look at, I wanted to go into some of these sectors kind of briefly. And I mentioned this at the beginning of the day, that a lot of the strength, when I look at some of the aggressive sectors, the areas that have been strongest within those sectors seem to be lagging today. I'm going to start off with consumer discretionary. I'm not going to pull up all these charts, but I am going to go through and just show you the little mini charts here as we go down the list. And just notice that the ones that are leading today, for the most part, are the ones that have been getting trounced. Just about every one of them up near the top have been getting hit hard in May. And so that's where we seem to be getting our biggest bounce. When you go to the bottom, these are ones that actually had been doing much better throughout 2019. Look at specialized consumer services. It's been one of the best one of the best industry groups in the market. And you can see the group, it's up today. It's up 1%, not bad, but it's just lagging. It's lagging a lot of the other areas. Broadline retailers, hotels, which had been pretty strong throughout. There's restaurants and bars that I mentioned earlier. So I could go through all of these groups. Banks, been under pressure, bouncing. Investment services, same thing. Asset managers, same thing. Go to the bottom. Insurance brokers, which have been strong, not really participating. Property and casualty insurance, specialty finance, and so on and so forth. So this is the kind of thing that we're looking at today. We're actually seeing the market bouncing where we've seen the most weakness of late. I'm going to turn it over to you, Erin, for upgrades, downgrades. What you got?
All right, let's go ahead and get started. I have 4 upgrades for you and 2 downgrades. So I'm going to use our new trusty, handy dandy ACP feature now. So let's take a peek. So one of the things, this is Atera Biotherapeutics. Citigroup downgraded them or upgraded them from a sell to a neutral, and they have moved their target from $23 to about $24. So they're neutral on this stock. They're thinking it's going to come back up, it looks like, but they're not looking for much of a break above and a closure of that gap. I think that it is very interesting, though, at this point to see that we did get this trend line broken right here. And nice trading above that. You can see also that the PMO, which is extraordinarily oversold right now, is beginning to come up for a buy signal. And where is our support? Well, this is when this tool is especially handy. Now let's go here. I'm going to give you a horizontal line so we can see some support and resistance. So we have to go all the way back here to find some support where we've just now bounced. So that's where we've bounced, which is right about there on that top we saw back there in 2018. Looks like or the December, right after the in December of 2017. So I've got the overhead resistance right here. So we could see a bounce back up to that area of overhead resistance. I'm just a little bit nervous about a biotech. It is very oversold, and this is a very promising PMO. But we're not getting the same kind of action I'd want to see out of the OBV here. Looks like we might be getting a higher top on this move. So, it could be interesting there. Let's take a look at Netflix. Netflix was upgraded today by Loop Capital from a hold to a buy. So I want to show you something really interesting here that I noticed when I was looking at this particular chart a little more closely. I brought the OBV up so that I could see it a little bit more. And notice that we have an upward rising bottoms on the OBV. And what's going on with Netflix? Well, we have a positive divergence going on here with volume. So I like this move to the upside. I think volume is really telling us that that's, that we can go along with that upgrade. PMO is really rather flat right now. I would like to see it turning back up just a wee bit more than it is right now. So we'll take a look at that and watch that later. But I think Netflix is looking pretty good on the upgrade. Red Hat, or RH, was upgraded today by Gordon Haskett from a reduce to a hold. So we got that upgrade. You can see a nice little breakout here coming out from this declining tops trend line here. That would be the more intermediate term one. We're just barely coming out above that. But if you take this down here a little bit more toward these tops that we have back here, and you can see we do have a little bit of a breakout going on when you're looking at these shorter term tops. And the PMO you can see down here is turning up. It doesn't have the buy signal yet. It is certainly on the oversold side. Let's go ahead and see what kind of support level we're looking at here when we move backward here. Let's go ahead and we'll put that support line in here, and we'll come out and look. And it takes us all the way back here into April, May, right here of 2018. And notice it did land right on the lows right here, and right about at that, well, it's not quite the gap right there, but came pretty close there. That's where the support lies. So I think this could be very interesting for sure. All right, so let's take a look at our next one, which would be T2. Take Two Interactive. All right, and there you've got a pretty nice PMO. It's a little on the oversold side. It does look like it's starting to move downward from that oversold area. We did get this upgrade though, so I think that's kind of interesting. Let's look at this a little more closely. It looks like we have a symmetrical triangle coming together here, right there. And symmetrical triangles, you should expect to see a breakout to the upside here because it is coming off of a rising trend. So I think that is pretty interesting as well. Okay, next one up. We're now going to move into some downgrades right now. Next, let's see, CY, Cypress Semiconductor was downgraded today by two agencies from a buy to a neutral with a price target of $23.90. So let's take this back just a little bit and see where that area lies. $23.90 is pretty high up there. I'm going to look right here at the overhead resistance that is being posed right now by these two tops that we saw earlier this year. We're now right up against that. So with the downgrade, well, let's see, actually, we are trading all the way up here. Let me give you a little bit of a circle there so you can see it. So quite a big gap up, and interestingly did come up off of that resistance today. So interesting that on a downgrade by two agencies, we did see this move up by Cypress Semiconductor. It came out today. I suspect they're thinking it's really overbought sitting where it is now, but with the 23.90, that's going to put you at your overhead resistance right there. All right. Next one up and final one we're going to look at is Kohl's. And we know that apparel retailers have been hit especially hard here. Let's go ahead. I'm going to make this a little bit so we can see that better. Declining trend is trying to be broken right now, but it hasn't quite managed to do that yet. PMO is still in decline. So I don't like the look of that PMO. And OBV is really going for the ride in the downside. So that's really confirming this decline. You know, it went from a neutral to an underweight, and they've moved their price target to 42. So I think that could be an interesting look as well. And that's all I have for upgrades and downgrades. Here are the lists of the ones that I didn't go over, as well as the ones I went over. I'll have those up in the Market Watchers Live recap. All right, Rick, it's time to bring you in. And I know you're going to be talking about a subject that a lot of our listeners and viewers are interested in as far as institutional trading. So I'm going to let you take it away.
Thanks, Erin. So as we mentioned before, it's been several months since I was last on. And we decided that it was a good idea to kind of come back, because since the start of my In the Know Trader show on Tuesdays at 3 p.m. on StockCharts.tv, we started back in December. Each week, we're kind of getting significantly more listeners. And what I hear from the listeners is that the content inside these podcasts is demonstrably different from what can typically be found elsewhere. And it's got a totally different angle on presenting market movement than most people have and are accustomed to seeing. So, and for if we kind of take a step back, the whole reason that I started In the Know Trader a year ago was to give individual investors access to models that they don't typically have a chance of seeing, as well as how institutions kind of play the market. So I myself have been on the street for almost 40 years now, holding some pretty high-level positions at major firms. Now, I started my career trading in the commodity pits back when there were commodity pits. Now, everything's gone electric, or electronic, better said. But I spent the bulk of the time trading stock index futures, and I also traded some COMEX gold and silver, and finished my trading career on the floor of the exchange trading cocoa futures for the last couple of years of the 12 that I was there. I was fortunate enough to be able to get a job at Morgan Stanley on the institutional futures sell side of the firm. After a couple of years there, Bloomberg came after me, and I became the head of commodities, futures, and technical analysis at Bloomberg. And in fact, I'm actually the person who designed Bloomberg's whole charting system. And then a few years later, Morgan Stanley came back to me and rehired me, this time on the equity side of the business, not the commodity side. And that was really the first time in my career I did on the equity side. And within 2 years, I was named chief market strategist at Morgan Stanley and did that for many years. Since then, I've worked at a few different firms. Most notably was head of trading strategy at Wells Fargo Securities. And then for the last 5 years, I've been consulting to the street, running my own businesses. And again, developed In the Know Trader as one of those businesses. Well, actually, what I want to do now, Erin, can we put up the poll and take?
Yeah, we'll put that together for you, and we'll be able to put that up shortly.
Okay.
So let them gather, but go ahead.
Okay, great. Mm-hmm. So the point of In the Know was to show you when and where institutional investors were more likely to make their decisions, combined using a variety of models that generally are more in what we call the market timing side of analysis as compared to pure technical analysis. And of course, I use technical analysis myself. I'm very well known on the street for being a technician, but I'm also a market timer. And as we all know in this business, it's all about timing. You can have the right idea, do all the right work, do your homework, and prepare, and yet somehow not get the results you want. So here I have a question for you, which is, which individual investors have the best chance of consistently making money in the markets? Those who look at both fundamentals and technicals, those who only look at technicals, those who only look at fundamentals, none of the above, and then looks like choice both 3 and 4 here. Now, let's see, are these still in the right order? No, they're not in the order that the question was, but the results show that if you know where institutions are buying and selling, you actually have a much better chance. So I don't know if we still have this live, Erin. Is
yes.
This still? It's still
and it
pulling?
will run at the through the end of your presentation, so we can look and see if the answer's changed.
Okay.
How's
Okay.
that?
That sounds good.
Perfect.
Okay. So let's go and go back here and kind of take a look at the S&P, a look at gold, the dollar, and the 10-year, and give you a sense of what some of these models that institutions have access to are using to help time what they're doing. So we'll start off here. I happen to have the U.S. 10-year chart up, and you'll see that besides price bars, there's some, a Fibonacci retracement here. Here's 38%, 50%, and the 62% retracement. So yesterday's low in yield terms got very close to 62% retracement, as well as similar to where an important 2017 low was. And of course, we're bouncing today with a decent bounce. But you'll also see a model here that many of you have not seen before. And this is one of the core models that we use in the No Trader, and of course to what I use for institutional clients that I consult to. This model was developed by a gentleman named Tom DeMark. It is only available on 2 platforms, CQG, which is the software you're looking at, and then, of course, Bloomberg. And these are an add-on costs to those platforms. Let me quickly show you. We're going to start here looking, and I'll give it a highlight just to make sure you see the same area I want to start looking at. We're going to first start into this area that we've put in an ellipse. You'll notice that there are numbers running underneath the price bars. And what that each number represents is, this is a weekly chart. So this is a Friday close, or if there's a holiday on Friday, it's the Thursday close. It's the close of the week, and each one of these bars that has a blue number in it has closed less than the close from 4 weeks prior. And when you do 9 consecutive weeks that the close is less than the close from 4 weeks prior, or conversely, let's take a look kind of in this space here, 9 consecutive weeks that the close is above the close from 4 weeks prior, you've moved enough in one direction to say that there's potentially further trend. It's the minimum movement that needs to be seen to define that there is exploitable trend. Now, a lot of times the 9 counts themselves end up turning the market, and you don't get extension of trend. But a lot of times you do get extension of trend. And in order to define then the exhaustion point of the trend is then doing another pattern, which we're going to put in here, which gets and ultimately ends up oops, I don't know why it keeps disappearing. Let's see. There we go. On a 13 count. And there are different ways and models that this is called a sequential model. So the sequential model has different ways of counting. And so, for instance, there's a 13 in here in red, and it's different than the 13 in maroon because in this count, excuse me, they count differently. In this case, we're looking at an aggressive sequential count. These are closes that are less than, gee, I have to remember myself. This is, gee, I'm trying to remember these. Well, let's do this. In a standard sequential count, the 13 count are 13 times that the close is above the high from 2 bars back. So after doing the 9 count up, which we finished here, the software then looks for 13 times that the close is above the high from 2 bars back, and it need not be consecutive bars. In this case, this 13 in here is suggesting at the time that it's a high-risk buy. Now, this was not a great signal, but nonetheless, for, I don't know, probably looks like 8-10 weeks, this did call a cessation of the uptrend until it finally kicked back in again. On the downside, what we're seeing here is the 9 count, again, followed by 13 bars closed less than low 2 bars back, and now this is, we're showing up right now with a 13 count. So the level we got to in the 10-year yesterday and this week is a place that institutions will likely sell bonds looking for higher rates, take some profits, and this is something that I was on Fox TV, when was it, I think it was last Thursday, with Maria Bartiromo in the morning, and we had said that anywhere from 2.17% down to 2.065% is the place that you're likely going to want to start taking some profits if you're long bonds. Now, of course, this is the yield chart, so this is the opposite picture, but essentially the same thing. So this is a model that we use to help define exhaustion of trend. And does it always work? Of course not. At the same time, I can't think of a single model out there that can more closely define the end of a trend while it's actually occurring. So here, let's take a look at, here's crude oil. And if we take a look at last year, when we got to close to $76 a barrel, just a week or two before, we're showing an upside 13, potential exhaustion of trend. It then sells down 9 weeks and gets close to where the bottom was, not the precise bottom, but starts telling you this is a place that you can easily see a pause. And this is the current picture. I'm going to flip to a daily chart. And the daily chart also very close in time to when the weekly chart showed exhaustion. I also had daily chart showing exhaustion. You can see now, too, that even though oil has sold down strongly from the 66th level of late April when it peaked, a month later, we've sold off, but it's only the pattern that developed over the last 9 days that was enough of a move that actually suggests now that you could be close to a bounce point in oil. And it's interesting because the same time the S&P is bouncing, and we know for the first several months of this year, oil and the S&P traded lockstep with each other. They were virtually as if you were trading the same instrument. You've now got oil showing a 9 count, again, 9 consecutive, daily charts of 9 consecutive days, close less than the close from 4 bars prior, in this case 4 days prior, and these are trading days, weekends don't count for anything. And a potential pause point to the downtrend. Aggressive traders tend to cover shorts and bid into this. Some will just start to unwind some shorts if they have them on. They don't necessarily go bottom fishing. But again, this is a model that can be extremely helpful in defining, from a timing perspective, where institutions will be trading. Now, if we go back in time also, let's move to the S&P. You'll notice that last year, as we were making all-time highs, let's see if we can blow this up a little. So essentially on all-time highs at the beginning of October, we saw a 13 count. Again, I'll just highlight it here. And then this 13 count in here was not good. We peaked against the old 13. And then, of course, we've been selling off. Now, there's also other models here on this page which are called propulsion. Propulsion is also a model that will target prices based upon the physics of how things trade, and do so in often calling points and exhaustion points to levels that you would never normally be able to see. And it's a more complicated model that I'm not going to go into the details of, but let me see if I can think of something. Let's look at, I think, the dollar index. Okay, so for example, this teal-colored line at 97.80 had been in place as an upside target back from September of last year. And it said that if we thrust through this level here, these kind of olive-colored, let's call them arrowed, a line that's kind of almost diamond-shaped or half a diamond shape, it would then extend to this level. And that's what we've done, hitting it about 5 weeks ago. A few weeks after that, we now on the dollar also have upside exhaustion, which is the exact, one of the ways we nailed the bottom in 2018 was not only did we have a classic 5-wave move down, this would be from the highs, 1, 2, 3, 4, 5. So we knew we were close to exhaustion, but then we get the timing model coming in saying you've exhausted the downtrend. And the flip side of that is this 13 signal that showed up. So we have turned bearish the dollar short term. My feeling is that as long as Trump is kind of playing chicken on the trade game with the Chinese and now possibly Mexico, the dollar is not going to be a favored currency with all this kind of politics coming into things. And you are seeing the dollar at least temporarily sell off. On a daily chart, let's take the ellipse away. Notice how many upside 13s we've seen, pretty much darn close to peaks. Notice 13s in here, sell down to a 9, rally into a 9. That 9 led to this 13, pull back, and then again, we've hit propulsion targets on the upside. I realize this is a lot to take in a short presentation, but the point is these models are what institutions use. Now, not all institutions, but those who are looking for even an edge themselves in being able to figure out when to put on trades. So let me give you an example. Let's say you're a value fund manager. So you're generally looking to buy stocks that are, quote, cheap, right? They're cheap in discounted cash flow or any other type of fundamental metric that values a company. And let's say a stock that used to trade at $60 is now trading at 35, and in all valuation measures is cheap. Does a value manager come in and buy the stock? Well, he may, or she may. However, maybe that stock trading at 35 isn't going to bottom until 26. You simply buy a stock because it's cheap. Well, I work with a lot of value managers because these models give me access to be able to figure out when trends have actually exhausted themselves. So something that's cheap doesn't mean it can't get a lot cheaper before it finally bottoms. So I've been using this model for, oh God, I think it's 24 years. It's a main part of what I do. And before we get a chance to do some Q&As and go over the results, I want to show you what, for instance, the tactical trader report from In the Know Trader looks like. So this is the most recent report. It comes out Wednesday nights each week. We take a look at kind of the big picture of what's going on. Here we've got information about sector performance. We include relative rotation graphs of the 11 macro sectors to get a sense of where there's potential opportunities. And what I'll tell you is each week we kind of do a deep dive into the S&P also, because when it comes down to it, knowing what the S&P is going to do, and that is the institutional benchmark as compared to the Dow or any other U.S. index, more portfolio managers are benchmarked to the S&P. Therefore, we concentrate on the S&P. We get into depth on where it's likely going. We had, as I mentioned, a 2720 downside target that we got within 1/3% yesterday. And then, of course, from the timing perspective, there's also stuff down here. Each week, we also put out a new trade idea. Now, everything we do in the Tactical Trader Report are ETFs. We do not trade individual stocks. We do that for a very specific reason, and that is as individual investors writing a newsletter that comes out once a week. I don't want to potentially get you into something that has an earnings miss or anything that can affect a single stock. The ETF obviously has much greater reduced risk because it's diversified across a number of portfolio holdings, and therefore I think it's a very good idea for individual investors to kind of stick in the ETF arena. So we put out a new idea each week in ETFs. This week it happened to be on SMH, which are semiconductors. And then we review every other open position that we have that we've had on. So until it's closed every week, we continue to talk about what we have. So for instance, we are short home builders. We took last week, we took 1/3 off at our first target down. These are other multiple bigger targets down if we have more substantial decline. But if we don't, at least we've pocketed some money. We take our profits. And again, we kind of update you across everything we've done until you walk away from the trade. And that's a look at what the Tactical Trade Report is. The last thing I want to do before I show you, we go to Q&A and we get back to the poll results, is I also want to show you, for instance, what I put out to institutions. Now, this is a completely different cost. This is far more expensive. But occasionally I do get people coming from the individual investor side who are successful people. They're trading their own money, but they may be trading millions of dollars, and therefore this may have more appeal. This is a much longer report. It goes through global macro. We're looking across the world at all different things and anything tradable that's a liquid market. For the year to date, 2019, year to date, the institutional report is up 34% on invested capital. And this is only across 12 trades. We show every trade and the results, whether they're closed trades, open trades, and open strategic trades, which are as compared to open tactical trades. We look at the U.S. equity market, same thing. We go into depth in the S&P, give very significant support and resistance levels. Anything else we're looking at, German, we've got an Asian position on. We always look at the U.S. 10-year. We go into the VAR exchange and look at the dollar every week, and then we make our way into commodities. Every week we always write about gold, which we're long. We read about gold stocks, which we're long right now. Copper got down to our target. And then every week we always write about oil, also getting very close to downside target. In fact, it did touch it because this is as of Sunday night, so we actually touched it yesterday. And then energy stocks. This is actually an interesting chart. This is the XLE versus the spiders. This is a monthly chart, and just so you can see, in fact, let me max this out. And well, I didn't expect it to give me 2 pages. Here, this is relative performance of XLE versus S&P over time. This is on 19-year lows. Energy stocks in general have been a disastrous long-term performer. In fact, in the last 10 years, only 2 years did the S&P Energy Index outperform the S&P. So in relative terms, this is back down to levels we saw in 2000. We're close to the all-time lows. However, I've got the 13 and the 9 that have shown up in the last several months, which means I'm starting to potentially look for a bottom. It's not there yet, but this is the type of thing where we can better time when to potentially come in and shift energy from an underperformer at least to an equal weight. Lastly, the last chart, this is probably our best trade we've had on this year. We're long solar versus XOP, which is oil and gas names. We're up 20% alone on this investment. So 20% return on capital on a pair trade, which is terrific. And then we finish up with something called the Daily Sentiment Index. This is a poll of how individual investors are ranked bullishly across the different markets. So unlike other polls you're accustomed to, this is all shown in percent bulls. And when you tend to get extreme readings when it's above 84% bulls or beneath 16% bulls. So you can see that like treasuries coming into this week are getting very close to being overbought. And again, that matches up to why we're willing to start taking profits in that space. So Erin and Tom, I want to turn it back to you so that we can look at the results and just kind of finish up if there are any quick questions that we can handle.
All righty. Well, we did get some in the chat room. I know that Bruce Fraser uses the point and figure tool to a lot of times do the counts for this. Do you guys use the point and figure? Do you use the point and figure tools or?
I personally do not use point and figure. I think these days it's there's nothing wrong with it. Point and figure charting could be a very good tool, and I probably know the top 2 people in the world who are the specialists in point and figure. I happen not to use it just because there's only so many things I can look at, and I think as time goes on, less institutions use it than I'd say 10 and 20 years ago when it used to be very prominent. So for me, my goal is trying to align clients with what institutions are doing. I think that's the way you want to look at the markets is to think and have a sense of when and what they're doing.
Okay. One of the other questions was, let's see, can you show your analysis of GLD using these metrics? I mean, I know you've got some other examples, but have you looked at the gold in this way?
Yeah. And here's gold. Here's GLD on that same chart. So downside exhaustion into last summer's lows. The sell-off that we had that peaked in February and sold off bottomed on a sequential 13. We've moved up. We are long gold for our clients and on the institutional side. And targets right now would be, let's say, 127.60-ish, and a much bigger move all the way up to 135. So yes, I look at this. That's a daily chart. You can look at it on a weekly chart. 13 peak in 2017, 13 bottom on the weekly chart in fourth quarter of 18.
All right, so you could really use this short term or longer term.
Yep. In fact, I'll show you something, and I have no idea if it's going to work or not right now. here's a 1 minute chart of gold for today.
Mm-hmm.
So buy signal right by the low of the day, sell signal here, which extended to a 9-count pullback. So, you don't always know if you should take them, but the way that DeMark would describe the use of this model is if you get a 13 down, he would define this as a really generally a bad time to to put new money in the direction of the trend. So if this has been selling off, you don't want to short now. That's the same thing as saying you don't want to first buy here. Now, if you did, okay, you could have made some money, but he's saying there's much higher than normal risk. And there is actually a pattern called a 9-13-9, and that's what this has done. So you can never get a 13 without a 9 first, but sometimes it extends to another 9, and that's what this has done. And then peak there against the propulsion. Now, propulsion is a totally different model, but back at 11:15 New York time or 11:17, something like that New York time, it said if we broke through 124.79, we would get to 124.97. And today's high is, darn close.
And then the last question I have for you is, do you also put stop loss orders in, or do you?
Oh, every trade in the No Trader and every formal trade that we put on has a stop loss and a target. And what differentiates me talking about something in written work versus a formal trade recommendation, let's say if I say in my commentary, I'm bullish gold and gold moves up, I can't say, oh, look, we made you money. We told you gold was going up, because I didn't give you a specific trade. I didn't tell you where to get in, where to get out, and where your stop is. But if I say, here's where I'm bullish gold, and here's where you buy gold, and here's our target, and here's our stop out, that's an official trade. And when we go and look at that, we go back here and we take a look at the results this year. These are on the institutional side, every trade with the exact entry, exit, and results. So everything we do has, that's an official trade, always has a stop. I never trade without stops. I know people will say, don't use stops, you're just going to get knocked out. Well, I mean, if we're up 32%, I'd say, you can do it. There is a whole talent in knowing how and where to place stops. And what I learned from all my years in the trading pit, Erin, is that you don't want to put your stops in the obvious places. And traders know, and these days algorithms know where stops usually are. So, and certainly when I was in the pit, we always hunted for stops because we knew, like, if we were going to take out the prior day's low, there was always going to be some sell stops underneath the prior day's low. So we'd hunt for them, and we'd push the market such that we try to make them go off. So we'd get short and push the market down to go beneath the prior day's low, cover into all those sell orders that came in, and then let the market do whatever it's going to do. I mean, it was all part of the game. So now algorithms do that. If you know how to properly place stops, they're not only an effective tool, but I think a must. And I vehemently disagree with the people who go, don't use stops because you'll get stopped out. You'll get stopped out if you don't know how to place your stop correctly.
Hey, Rick.
Yeah, Tom.
First, great presentation. Just sitting there with my mouth open watching all of your moves and the way that these different charts have turned right when you get to the areas where you expect exhaustion. So very, very good presentation. We're going to go ahead and pull that poll up one more time and see how many people you've convinced here. And I've got a question for you, just kind of an off-the-cuff kind of question, because you talked about crude oil and the fact that it's been going down and it's now gotten to a point where you expect maybe a little bounce. You also said short-term, you're bearish the dollar. And of course, if crude oil prices move up and the dollar moves down, that's two double bonuses for, say, the XLE. So is that an area that you would favor at this point, energy, after it's been beaten down so much in the last 5-6 weeks?
In relative terms, I'm just not there yet. That doesn't mean energy equities on their own can't bounce. So if the market bounces and oil bounces, they may bounce. But the bigger question is, will they bounce more than the S&P?
Right.
Right? Because otherwise then it's, you're buying them, but you could put that money and do better elsewhere.
Yeah, I agree.
I'm just, kind of waiting for some signs of life in the energy space. And we're so close to the lows from 1999 when XLE started trading. Now, that doesn't mean that if we went to the actual S&P energy index, there might be a lower low. But since the XLE has been trading as an ETF, in relative terms to spiders, it's very close to all-time lows. So we may very well take, not bottom until it makes a new all-time low. So I'm watching it. I want to see some signs of life before I come in and at least move the group up to an equal weight.
Yeah, and it makes sense too, because the XLE, like you said, has been underperforming the S&P 500, and the start of that underperformance began back in 2011 when the dollar began its move to the upside, that longer-term trend in the U.S. dollar index.
Correct. That chart that I showed you of XLE versus SPY has truly been a disaster for 10 years.
Yep. Completely agree. All right, well, we got one final look here at the poll. Looks like we've gotten several more respondents in, and 70% are still sticking with the 3 and 4, which is the next two answers, those who look at both fundamentals and technicals, and those who know when and where institutions are buying and selling. So I'm going to give you the last comment on this poll and the results.
Yeah. So to me, I've always been technically inclined, and I don't have the personal knowledge to dig deep into a company to do the fundamental work that a fundamental analyst on the street knows how to do. But that doesn't stop me from being able to get that type of information from those who do. And whether it's free on, Yahoo Finance, you can find out what the average price target is, and you can get a lot of the fundamental information. The technical work, clearly I've done myself now for 35 plus years. But I'm glad to see at least that 8% of you, or perhaps the second biggest choice, because it looks like we're definitely missing, this doesn't equal to 100%, but well, does it? Let's see. Do we have it? Does it equal? Yeah, it does.
It does. Yeah.
The knowing when and where institutions play is the biggest edge you can give yourself, besides your own skill of, let's say, reading a chart and whatever fundamental work you do. And there's not a lot of resources out there at all that you can find that type of information from. And I realize that I've always catered and worked for institutions, either as an employee of them or in consulting. And it occurred to me a year ago, the little guy, the individual investor, doesn't have the same edge that institutions do, doesn't have access to the models they do without spending a lot of money to get those models.
Yep.
And it made sense to me to start an individual investor newsletter such that I could provide individual investors that type edge, the ability to make those type returns. And everything we do in the No Trader report each week relates to those models, the timing of those signals, propulsion targets, everything like that. It's the same analysis I would do for institutions. The difference is which markets I'm covering and the depth of it. So in the No Trader, the Tactical Trader report, which right now is the one and only product that we have available in the No Trader, the same analysis is done, but we're looking at ETFs, and even though we can pick an ETF from anywhere in the world, we can have on a exposure to the Nikkei through an ETF, so it doesn't mean we're only U.S. centric. But the writing, what I do is, I'll write about the U.S. market, the S&P, and then we'll go into a specific ETF trade idea each week.
Yeah, Rick, I'm sorry, I hate to cut you off, but we were going to have to get moving.
Sure.
But I just want to tell you, this was a great presentation. We've had a ton of questions in the chat room. A lot of folks are very interested in where to get your software. So if you could just quickly just let them know where they can get that, that would be great.
The software, again, is available on Bloomberg as being a professional client of Bloomberg, or through another company called CQG. So you would have to get the CQG charting package with DeMark indicators. And again, this is not inexpensive stuff. The other thing is, check out my website, inthenotrader.com. I have tons of videos up there, and that's where you can get information also about subscribing to our weekly report.
All right, sounds good. I'm going to just pull that up for everybody real quick so you can just see. There it is, inthenotrader.com. So if you want to check out some of Rick's work, feel free. And Rick, always a pleasure to have you on the show.
Thanks so much, Tom and Erin. Appreciate it.
All right, there he goes. Great presentation. And Erin, I think we're just going to jump right into the 10 and 10. You ready?
Oh, yes. We have lots of fun stuff to do still. Okay, so first one is VERI, and there's a tie right now. So in the chat room, guys, so vote.
All right, VERI, Veritone. First of all, it's been in the software group and has been a laggard for a long time, but it's starting to show signs of life. Relative strength here, very strong. Volume, great. Broke out above some key resistance levels. I think as long as this holds about $7.50, $8 to the downside, I like it. I think it's starting to show some nice relative strength.
All right, perfect. Most popular in the chat room is Domo, D-O-M-O.
Yeah, another software stock took a big hit yesterday, broke down. I mean, you've got another gap support level. So I'll identify both of these. After gapping up, you can see we had put in some pretty important lows here, right at about 34, 34 and a half. That failed. Now we've got the bottom of gap support, which we actually went a little bit below yesterday. The biggest problem I'm seeing now is about 10 weeks of relative underperformance now in this stock versus the software group. And I will throw one more level in here right there. I think if we lose that relative low and we're right on it, I would be out of the stock. I'm not liking what's going on here. Volume hasn't been that heavy, but I think you got to draw your line at some point. I think a close below yesterday's low would probably get me.
All right, let's see. Next one up will be Tilray, T-L-R-Y.
Yeah, I was just looking at this one yesterday and really kind of disappointing in many of these cannabis-related stocks. Tilray just continues to drift. Look at the 20-day moving average. I mean, if there was one thing that I would point out here on this chart is that as long as price remains below a downtrending 20-day EMA, it's really hard to be excited about it. I mean, it gets these little mini pops from time to time, but every one of them so far is failing at that 20-day. I mean, unless you get all the way down to the major support level where after it went public down closer to 20, until you get there, I think we've got some issues. So I'd wait until we get back through that 20-day moving average.
All right, let's see. Next one up is JP Morgan.
Yeah, banks having a really nice day today. Finally getting a little relief on the 10-year Treasury yield with a bounce. But check out the two moving averages that we are trying to get through here. This is this could be a very important short-term issue. You can see the failure there at the 20, and now we're at the 20 and the 50. If we could break above both of these moving averages, maybe it would start to make some sense. JP Morgan, relative to the banks, very strong. So you have one of the better banks if, in fact, we can start to make some more headway to the upside in the banks. But you can see the overall downtrend in relative strength in the banking group. That's been the big problem. It's not JP Morgan. It's just the fundamentals for the banking group with the 10-year Treasury yield dropping, the yield curve getting closer and closer to that flat line. I mean, all of these things are impacting the banks, and JP Morgan's going along for the ride.
All right. We actually had 3 requests for restaurants and bars. I decided to pick Wingstop. Having a good day today.
Is that Wing?
Yep.
All right. A Wingstop. Yes, very nice day. And this is what I was talking about earlier. Remember, I think was talking about Cracker Barrel not being a very good stock relative to its peers. Well, check this one out. I mean, this is, yes, we got a nice pop to the upside here. Got that nice gap today. But this didn't just happen today. I mean, if you're looking at this, we just broke to a multi-month high with this move today. But we've been uptrending for the last few months. So this is a stock that's in a group that's strong, and also a stock within the group that is very strong. So I think the combination of that, this is a stock that certainly would be on my watch list.
Okay, let's see. Next one up. We haven't looked at Qualcomm in a while. QCOM.
All right, Qualcomm. This has been one of the most volatile stocks of 2019, just all over the place. Big level I think we've got to get through is, I'll annotate that for you. I would like to see the stock get back up above that 70 and a half area. You can see that's where we had the big gap up. Up here, this is a big island, but after putting in this island, you can see the huge gap back down. I think we got to get back through 70 and a half, maybe even keep an eye on that those two moving averages, which are about to cross here just above at about 72 and a half. But those are the two levels that I would watch the upside. In the meantime, I'd hold off, but volume and a move back through those moving averages, I think, would be bullish.
All right. Let's see. Next one up is Zillow, Z.
Yeah, Z had gapped up with its earnings, pulled back, and right here, pulled back to the 20, continuing to move higher. We're getting close to a major overhead resistance, but this is a stock that's been very strong relative to its real estate services group. So here you can see the overhead resistance. This is where sellers have come in. If I was in it, I think it'd be time to ring the register. Let's see if we can get through. That is the price high for the last 7 or 8 months. But the one very encouraging part here is when you look at the relative strength to its peers and to the S&P 500. So the stock is definitely improving, nice volume trends, but we do need to get through about 44 and a half before I'd be even more bullish.
Okay, let's see. Next one up is going to be GLDD. I know we haven't looked at this. Great Lakes, heavy construction. What do you think, heavy construction?
Well, I don't like the space very much, but this has been a good performer within the space. So I think your gap support down here between 930 and 960 is kind of what I would look for longer term in the event we pulled back. Short term, we're looking to get a breakout above about 11 and a quarter.
All right, next one up and Boeing, BA.
Yeah, Boeing continues to struggle. We've seen it drifting lower. I marked that 360 area once before as key resistance. We really could not get through. And so there it is right there. Here was the gap down. Remember, we talked about this, needing to get through 400. We couldn't. We held the support, bounced, and then fell below 360. Look at all the failures at 360 as we move down. Now what I would say is we had a nice hammer yesterday at about 338, 337. So I think right now we're just stuck in this range. Let's see which one breaks first.
All right. Last one is TDoc. Teledoc.
All right, TDoc. Drifting lower. I mean, it's in the software space, which has been a good space. The problem I have with this stock is the relative strength of the stock versus its peers. So it topped many, many months ago and has been downtrending. So it's not that I dislike this stock. It's just that if I want to be in software, I want to be in one of the leaders, and I'm just not seeing it here. Yesterday, when software was weak, it broke below some recent support. So I think, you've got a little bit of support perhaps coming up if it gets down to about 50. So I'd watch for that. But I'm just not going to be a fan of a stock that's underperforming its peers.
Okay. That will conclude the 10 and 10. There are the symbols. I'll have them up in the Market Watchers live chart list. And right now, we will be back after this message with the final market update.
Market direction is the single most important thing all investors need to know. Get the advice you need by joining dozens of elite money managers and financial experts, including Steve Forbes, Paul Merriman, Tom McClellan, and Keith Fitzgerald at the Money Show Seattle June 15th and 16th. You'll hear real-time market analysis and learn which stocks, bonds, funds, and commodities you should buy and sell to build a safer, more profitable portfolio. Claim your free pass at seattlemoneyshow.com.
It's time for our final market update. As you can see, certainly what a difference a day makes, as Tom said earlier, having really great movement right now in the Dow. It's up over 443 points. S&P 500 up over 48. The NASDAQ is having the best day right now. It is up over 2%, 2.16% currently. New York Stock Exchange doing very well. Notice that it has overcome its high for the last 5 trading days, whereas we didn't see that on these other ones too much, except for the Dow. We've got the Russell 2000 small caps also making a nice move, currently up 1.88%. TSX is having a good day, but it is a laggard as far as our major indexes. It's up only a little over 0.5%. Treasury yields are up, reading 2.145%. VIX is falling, but we are still looking at a reading over 1731. UUP is mostly unchanged, up 1 cent to 26.19. GLD has been moving sideways, but is down 0.2%, currently reading 124.86 for GLD. USO is up over a little over 1%, reading $11.11. And TLT, after its really shooting star a couple of trading days, is finally pulling back, down 1.36%, currently reading 130.65. I'm going to go ahead and pass it back to you, Tom.
All right. Yeah, I wanted to follow up a little bit on the dollar here. First of all, I like to compare Treasury yields here in the U.S. versus Germany. And you can see that for the most part, it's going higher. As a result, the dollar normally follows that to the upside. But I did want to point out that there is an inverse correlation that's been building. It's only happened to this degree about 3 other times in the last decade. And so what's happening is we're seeing the U.S. Treasury yields dropping faster than Germany's. And normally what that means is a move down in the U.S. dollar. And instead, the dollar has still been moving up until just these last couple of days. So I think what this is probably signaling is, and I kind of agree with Rick Bensignor, and I think, Erin, you were talking about this as well. I'm looking for the dollar here in the short term to maybe take a hit, which definitely would bode well for gold. So that is something maybe to keep in mind as well. Doesn't happen too often, though, when we see that inverse correlation between the direction of the dollar and the direction of U.S. Treasury yields versus Germany's. So I wanted to point that out. Okay, we are going to move into one of our final segments, and this is sector rotation. Erin, why don't you take it away? What you got for today?
All right. For sector rotation, I decided I was going to start right here with our sector summary. And then what I like to do, as most people know, when I do my scans or anything else, I like to look at them in terms of a candle glance. And I have set up my own candle glance style. And you can do that simply by saving what you would like your candle glance to look like, and then saving that chart style as candle glance. And then you're going to always get what you like to see as far as the candle glance look. So what I wanted to do is, this is a big picture look, and it helps me sort of decide which areas look the most healthy or maybe are making the right moves. Now, clearly, if you look at the PMOs, one of the best PMOs right now would be the materials sector. And as you can see, we're getting ready to have that positive crossover to the upside. We're getting that nice breakout. And we just barely avoided a 5,200-day negative crossover, or a death cross, as some people will call that. So we're making this nice move. I find I'm a little suspect of this area. I think we are going to see some improvement. Obviously, the metals are starting to take off here with the problems with the market and the dollar. But we're getting ready to hit some overhead resistance here at about 56.50. So while I think this is a good area right now as far as sector rotation, I don't think I would be going in there necessarily until I saw this declining trend really starting to move to the upside, and it could beat out that overhead resistance I just showed you. So that's something that I'm concerned about when I look at that chart. But as far as the other sectors go, I like consumer staples. Notice this nice move, this really great trend out of the December lows. It's just been very much, it's a nice steady trend. We got the pullback, and I think this is now the time to start looking this space once again. And it's interesting, Tom, because this area of the market tends to be very unsexy, as we call it. It's usually more of a sideways mover, kind of like what we're seeing going on with healthcare here. That was the other one I wanted to point out as far as the PMO goes. So we have these rising bottoms on the PMO, which I like. It has been moving mostly sideways, but we have gotten a lot of sideways action here. Looks like we're in the middle of a possible trading range where we could make it back up here to that 91 area. My interest is peaked by healthcare right now. You know, we had a great performance, but it pulled way back. We haven't gotten that much out of it, but I'm looking for healthcare to start showing some improvement here. I think that PMO buy signal, hopefully we'll get that above the zero line, but I'm liking the healthcare area of the market a little bit more right now. So let's go back here and take a peek. So really, when I look at all of these, I'm going to concentrate, I think, on XLP and XLV, and I'm going to show you why. So I'm going to take us back into, let's see, so there's XLP. I don't want to go there. I'm going to go back to our sector summary. And if I press on the consumer staples, if I click there, that brings me up all the industry groups. And so I just wanted to see what industry groups have been doing, which ones have been doing well in the staples sector over the past week. If I'm looking for a shorter term trade or, something that's going to last a couple of weeks, a lot of times I'll go and look for the areas that have really been performing well. And you can see the top three are the food products, soft drinks, and personal products. So I'm going to take a peek at personal products by just clicking there. And you can see here are the 20 stocks that we have listed in that industry group. I can sort them by scooter. I like to look at stocks that are between that 70 to 80 range. I think that gives them some upside potential. So I would say, looking at this, obviously, we want to possibly look at Estee Lauder and Unilever. So EL and UL would be the ones that I'd be interested in. I'm not sure which ones you're concentrating on today, Tom, but I think, not too bad going on for staples. Look at that declining tops trend line here on Estee Lauder. We're getting the breakout. PMO is turning up. I like it. Unilever, UL, forming a symmetrical triangle on the end of a very nice upswing. The PMO is looking not quite as good as I would like it to look, so I might pass on this one. But it's certainly an interesting one to look at. So
I got a little bit here too. I'm going to go ahead and just quickly look at the sector summary, which is where you started. But I'm going to start with the year to date, because sector rotation, I think, has actually been very healthy in 2019. Real estate considered more defensive leading, but when you look at the next five on the year, technology, industrials, consumer discretionary, financials, communication services, all aggressive groups. But if we switch this and just look at the last week, it's been a huge, huge move up on material stocks relative to everything else. And I think the big drop in the dollar and what I just talked about with the U.S. Treasury yields beginning to drop very fast versus Germany, I think this could set up short term for continuing outperformance by materials. So if you look at the relative strength chart, this is XLB versus the S&P 500. We've really topped out at about this 0.0202 level. And all this is a ratio. But notice when we dipped down in May, we did not take out the October low. I'd be watching to see if we can get back up above that level, because that would take us to about a 7 or 8 month relative high, which I think would be it would bode well for materials. So I think that'll lead us really well into the final segment, which is relative strength. So I'm going to turn it right back to you, Erin, for some relative strength.
All righty, let's take a peek. So I was concentrating, as far as the sector rotation, on the personal products area of consumer staples. So I thought I would do a scan. I'm going to take that out of personal products or medical equipment, because I found that one to be interesting as well. And I will put the scooter in here very quickly. We'll look at scooters that are above 70. And so I just click add, and there we go. 70. There. Run the scan. And here are the results. We have about 33 of them. So I'm going to just quickly move this into my scan dump. And then I'm going to show you how you can use the PMO as a relative strength determination. You can use the PMO. How do you do that? I use it through Candle Glance. Again, Candle Glance being my favorite. I want to look at the PMO rankings for the past 6 months. Now, it is going to change my Candle Glance look, but I'm doing this so I can add my indicator, which is the PMO. And I'm going to have it sort from descending. So the highest PMO values will be at the front. That means those are the ones that are the best performers right now. Their value is higher than the others. And, you know, typically these have ranges, but that's okay. We still can use these readings for relative strength. So when you look at this, relative strength is telling me by looking at which ones are the top, you know, we are seeing PMOs that maybe aren't doing what I want. They're overbought. So I can just work my way down. Here's one, Tandem. You've got that move on the upswing on the PMO, and it looks like an ascending triangle starting here. So I would be looking at Tandem Diabetes just based on the PMO value and the way it looked from the Candle Glance when I added the indicator. So that's one way you can look at relative strength, is simply by going in and ranking your group by their PMO value. So similarly, if we went the other way, descending from ascending, these are the weakest ones, the bottom of the line. So I'm going to pass it to you, Tom, so you can show me what you're going to do for relative strength.
All right. Well, the first thing that I'm going to do is I actually have a folder where I've got all of my industry groups relative to the S&P 500, and they're all set up on 3-year weekly charts. So I could go in, for instance, depending on which sector I want to look at, I've got the XLK all lined up with the various groups after it. And then I've got consumer discretionary, communication services, and so forth. So I've got the first 5 aggressive groups, but I'm going to continue on that theme of the materials. So let's say that I am a fan of materials. Where do I go from there? Well, I'm going to go into my industry groups and start to compare those to the S&P 500 to try to see where maybe some of that relative strength is. And what I like to do, I tend to use 2 criteria before I'll invest in a group. I like to have the relative strength above the 20 and the 50-day moving average, preferably with the 20 above the 50. And then I also like to see this PPO moving into positive territory, because that's just telling me that the relative momentum is positive. So as I go through here, I really struggle to find any, but I believe there is one. Here is your mining stocks, starting to show some strength, but still negative relative PPO. Then you've got the paper, which has been under tremendous pressure to the downside. Not going to be interested there. This is the one I like, containers and packaging, because when the overall group has been going lower, when we've been watching materials underperform throughout 2019, here's a group that actually has been able to outperform the S&P 500 in 2019, even though it's part of a group that has been wildly underperforming. So you've got some relative momentum here. And if money begins rotating into materials, even if it's just for a short period of time, I think this is the type of group that I would be looking at. So here you can see the relative strength. The actual relative strength number right now is above the 20-day, which is above the 50-day. And you can see that the PPO is positive. So this is at least a group that has shown some relative strength. And now the question is, so where do you go? Well, I went into the sector summary, clicked on materials, clicked on the containers and packaging, and now I've got the stocks within this area, and I simply clicked on the scooter column, because remember, the scooter is a relative strength tool. It tells us how stocks perform relative to their market capitalization peers. So, for instance, CYRX, Cryoport, is ranked very high relative to the small caps. So if the small caps are something that you're interested in, this stock's down 3% today, but it's got a great scooter rating. So maybe we would pull this up and take a look at it. And you can see you've got a really nice looking chart. in a industry group that has shown some relative strength, but in a sector that has been very weak on a relative basis. So this is the kind of stock that would interest me if I were to take a look and look for some individual stock trades. And actually, that was a 1 week period, by the way. So if I change that to intraday, you'll see actually that stock's having a pretty good day today. Some others, let's say you wanted to look at you needed it to be a large cap. You don't want to trade small caps. Well, then you've got BLL, which has been a tremendous performer for quite a while. This is another stock that I think is healthy. I don't want to get into stocks that are unhealthy, because if all of a sudden material starts to turn back to the downside, chances are those unhealthy stocks with unhealthy PPOs are probably going to roll right back down with them. I'd rather be in a group or in a stock that has already been showing relative strength. And if more and more money rotates into the group, the leaders should see more and more of that money. And we're seeing some of that today with some of the stocks that I'm mentioning here. But again, you've got a PPO above the 0 line, the stock trading above the 20 is above the 50. So these are the types of things that I would be looking for. Now, I did want to mention one other group, and this is a group I've talked about here on Market Watchers Live for quite some time. It is in the industrial space, and it is the defense group. Now, I have grown much more bullish defense, and I've talked about this literally throughout the last month. You can see the relative strength that is just pouring back into this group for the past 2 months. Look at this push to the upside. The PPO now is above the center line. I think we're beginning to see a lot. And by the way, that trend line, if you connect those two peaks in 2018, that also has been broken. So I think this is an area of the market that I'd be very interested in. And so taking a look here, you could go back into the industrials, hit defense, sort it by scooter. I'm in L3. This is the top performing stock. This is one of my favorite stocks right now because it's in a strong group that is outperforming the market. And this is right now the strongest stock according to the scooter rank. But if you look at the chart, you can see it's just been powering to the upside. So if you like defense and more stocks are coming into defense, then this is, looks really good. So anyhow, that is it. We are going to just summarize there some of the things we talked about in sector rotation and relative strength. And
so it melted together very well, actually.
Yeah, and the two kind of go hand in hand. I mean, when you're looking at sector rotation, you're kind of comparing them to the other sectors and what's going on. So kind of thought these two would kind of go hand in hand and give you some ideas how maybe to navigate this market, because it's not an easy market to navigate. You can see that just from the last 2 days.
Exactly. I know everybody's probably thinking that as they look at their portfolios.
Yeah, I mean, here's the summary, and you can see the Dow Jones currently up 440 points, as you mentioned at your last update, Erin. NASDAQ getting back a lot of what it lost. Well, it actually got back more than what it lost, whereas the Dow didn't take that big hit yesterday. So it actually has been doing much better on a net basis these past couple of days. So some of the larger cap, maybe a little bit more defensive stocks the past 2 days, from an aggregate basis, I think actually performing better than NASDAQ stocks.
I agree.
All right. And you can see the Russell 2000 there, by the way, trying to show some relative strength. We've been waiting. June is the month for small caps. June is the month for healthcare. And I know one of the things we talked about yesterday was that PSCH, which was a small cap healthcare ETF. And that thing's been doing pretty well today. So something to keep an eye on as we go in through June as well. All right, there is your upcoming schedule. I want to thank all of you for being with us today. Special shout out to Rick Bensignor. Always a pleasure to have him on the show. Great talk today. Please remember to complete the survey as you exit. It's located below the video player. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. We'll see you back here tomorrow. Happy trading.